Today, we're going to talk about a topic that is on everyone's mind: central bank digital currencies or CBDCs. The world is rapidly evolving, and so is the way we transact. With the rise of cryptocurrencies, digital currencies have become more popular than ever before. However, there is a new player in town, and it goes by the name of CBDCs. CBDCs are digital currencies issued by central banks, which means they are backed by the government. They are different from other forms of digital currency, such as Bitcoin or Ethereum, because they are not decentralized. Instead, they are centralized and controlled by the central bank. But why are CBDCs important? Well, for starters, they could revolutionize the way we transact. They could make transactions faster, cheaper, and more secure. And that's just the tip of the iceberg. So, without further ado, let's dive into the world of CBDCs. What are CBDCs? Central bank digital currencies, or CBDCs, are a new form of digital currency that are issued and backed by central banks. Unlike cryptocurrencies such as Bitcoin, which are decentralized and operate independently of any central authority, CBDCs are centralized and controlled by a central bank. CBDCs can be used for a variety of purposes, including facilitating payments, reducing the cost and time involved in cross-border transactions, and improving financial inclusion. They differ from other forms of digital currency in that they are backed by a central authority and have the potential to be integrated into the existing financial system. Why are CBDCs being developed? One of the main reasons that central banks are exploring the development of CBDCs is to improve the efficiency and security of payment systems. By creating a digital currency that is backed by the central bank, transactions can be settled instantly and securely, without relying on intermediaries like commercial banks. This could lead to faster and cheaper payments, especially for cross-border transactions. Another potential benefit of CBDCs is financial inclusion. In many countries, a significant portion of the population does not have access to traditional banking services. CBDCs could provide a low-cost and accessible alternative, allowing people to participate in the formal economy and access financial services. However, there are also potential drawbacks to CBDCs. One concern is that they could lead to bank disintermediation, as consumers and businesses may choose to hold their funds directly with the central bank instead of depositing them in commercial banks. This could reduce the availability of credit and disrupt the traditional banking system. Additionally, CBDCs could pose risks to privacy and data protection if not designed and implemented properly. How do CBDCs work? Central bank digital currencies, CBDCs, are a form of digital currency that is issued and backed by a central bank. Unlike cryptocurrencies like Bitcoin, which are decentralized and operate independently of any government or financial institution, CBDCs are centralized and closely regulated. CBDCs can be created in two ways, either through direct issuance by the central bank, or by allowing commercial banks to issue them on the central bank's behalf. In both cases, the CBDC is created electronically and stored on a secure digital ledger, similar to the technology used by cryptocurrencies. Once created, CBDCs can be distributed in a variety of ways. One option is to distribute them directly to individuals, similar to the way stimulus checks were distributed during the COVID-19 pandemic. Another option is to distribute them through commercial banks, who would then distribute them to their customers. The exact distribution method will depend on the central bank's goals and priorities. Implications of CBDCs. Central bank digital currencies, CBDCs, have the potential to revolutionize the way we think about money and finance. As digital currencies issued by central banks, CBDCs could offer a range of benefits, including faster and cheaper transactions, increased financial inclusion, and greater transparency in the monetary system. However, there are also potential drawbacks to CBDCs that must be carefully considered. One concern is their impact on monetary policy, as CBDCs could potentially disrupt traditional methods of controlling inflation and managing the money supply. Additionally, CBDCs could pose risks to financial stability if they are not properly designed and regulated. Finally, there are concerns about privacy and surveillance, as CBDCs would allow central banks to monitor transactions in real time. In conclusion, we have explored the world of central bank digital currencies, CBDCs, and their potential implications. We have defined what CBDCs are and how they differ from other forms of digital currency. We have discussed why central banks are developing CBDCs and explored the potential benefits and drawbacks. We have also explained the technical aspects of CBDCs, including how they are created and distributed. Moving forward, it is clear that CBDCs have the potential to revolutionize the way we think about money and financial transactions. However, there are also significant risks and challenges that must be addressed. It will be up to policymakers, regulators, and stakeholders to navigate these issues and ensure that CBDCs are developed in a responsible and sustainable manner. As we look to the future, it is likely that CBDCs will play an increasingly important role in our financial systems. Whether they ultimately prove to be a force for good or bad remains to be seen. But one thing is certain. The world of finance is changing rapidly, and CBDCs are at the forefront of this transformation. If you came to here, congratulations, you are more informed than other people on the subject of CBDCs. If you found this video informative, please like the video and subscribe to the channel for more content like this.